Gentlemen, and welcome to the panel on private equity and infrastructure. We have a bit of twofold, but we have a lot of crossover as well between infrastructure and a private equity base in investing, as well as whole private equity. We'll have about 40 minutes, 30 minutes panel, and for the last 10 minutes we'll open up the mics for questions. My name is Thomas Breitenmoser. I'm heading up the consulting and controlling business at Complementa, and I'd like to introduce to our panelists. On my far right, it's Markus Benzler. Markus Benzler is head multi-managers private equity at UBS Asset Management. He really goes there across the board from private equity, private markets, as well as part of real estate. And he's also in investment committee of the infrastructure, private equity type of investments at UBS. Then with me in the middle, Naji Nehme. Naji Nehme is Chief Investment Officer of Petiol Asset Management. He heads up the whole private markets team with a focus on private equity. And then last but not least, Christoph Gisler. Christoph Gisler is Head Infrastructure Equity at Swiss Life Asset Managers and is there also on the board of the Swiss Life Asset Management as well. And of course, focusing on infrastructure. And I also like to fire away on the infrastructure team. Infrastructure is something which became very topical in the last probably 10 years. It has a lot of support just because of the environment where we had this ultra low yield in there. That's one point where investors wanted to have some illiquidity premium. On the other side, it's also a very long-term investment, which therefore for institutional investors, especially those which have some liabilities to look after, is a perfect match. Can you elaborate a little bit on those points, or much more, since now yields came up in the traditional fixed income market? Is that still a trend which is your friend? Christoph?
Well, actually, as you know, the market is not always like this. Sometimes it's bumpy. But in the infrastructure space, I mean, we are not trading around. We are not timing investments. You know, we do not buy an asset, hold it for 3 weeks, and then sell it off. I mean, infrastructure like energy production facilities or towers in the telecommunication sectors, railways, roads, they are there for several generations. And, you know, this asset class is there to stay. It always has been, there always were investors investing in the asset class. It's not just a sexy little small asset class and a trend. It is because a lot of investors see that if they add that to their portfolio, in addition to fixed income, listed equities, or real estate, that they can build more efficient and more resilient portfolios over a long time. And as these are real assets, I mean, you know, these trends, it goes up and down. We benefited a lot with cheaper financing costs over the last couple of years. But it's still quite attractive. You know, the cost of capital on the debt side is still quite cheap if you compare that for the last 30, 40 years. And as some of these investments benefit as well, they can create additional cash flows if the interest rates go up in the long run. And I think a pension fund or an insurance company doesn't think about 3 or 6 months. We talk about the next 10 to 20 years. Where we want to buy in a cash flow and can generate absolute returns.
Markus, would you agree with that statement that just higher interest gives a higher cash flow, or has something happened or changed because now we have this still higher financing cost? I mean, on average, infrastructure is about 50% debt, so that's not nothing when you pay 5% for it instead of 0. So maybe
I would say, especially for new deals, these things are usually baked into the whole package, right? So people obviously look into what is the current environment, what is inflation, what is the asset, what are the terms, what's the risk, and then they adjust to that. So we see that actually in many parts of the private market. So a problem is probably more for some old assets which are in portfolios, and maybe from the interest rate side, things have not been properly taken care of or hedged. But for new assets, new deals, I think these things are usually baked into, right? Because people have the target returns. And so from that perspective, I don't see too much really of an issue. And infrastructure, maybe from our perspective, last year has actually considerably performed well. So what we see that a lot of the infrastructure investments, even last year, have still delivered high single digit or low mid-teens in terms of net returns, where most of the other private markets have actually lost money, right? In the year before, for example, coming then to private equity, for example, a lot of investors had like in 21, 40, 50, 60% returns, and infra was maybe only 15, 20. But then last year, returns have usually come down on private equity side, or mostly it was a loss, let's say 10, 15% in many portfolios, and infrastructure continued to perform, not as good, but still, I would say, on the target returns. So that actually will help, I think, investors to further appreciate the asset class. And as a last element, there's just a huge infrastructure need still on the planet. We're talking here then about greenfield new projects, but there is so much need still in the world, and we see actually a bit of a tendency that more and more professional infrastructure investors move not only from brownfield as existing infrastructure product or projects to also greenfield, taking more risks, not usually a big part of the portfolio, but entering also in the territory where there's a real need for most economies, quite frankly.
Okay. Naji, you want to comment maybe on the need on infrastructure in there? I mean, I think you're located in London, is that correct?
No, we are located in Zurich.
Oh, okay, sorry that I...
Let me introduce us then.
Yes, please, please.
So we are a small boutique asset manager in Zurich. We established in 2018. We're running close to $2 billion and across private equity, real estate, and private debt, and we do it on a co-investment portfolio approach. So infrastructure is not something that we have done, and I think it's part of what you have mentioned initially. The long duration of the asset when it comes to infrastructure doesn't fit the client base we have. We're serving much more family offices, multifamily offices, and it's not the insurance companies. But today, I think we have a very open mind. So today you look at infrastructure debt, which I would love to hear about our experts in this field. But I think with interest rate rising, infrastructure debt might be an interesting play for people like us, because we can target maybe good absolute returns, but still have a short duration play in this theme. So I think that is one thing that we will be starting a bit to look at on the infrastructure side. And if you want to add on,
although it's called private equity and infrastructure in there, but you can also talk on the debt side.
Yeah, I mean, infrastructure debt, for example, is very interesting right now as well, because as Naji told, it's much shorter duration. So if you want to create 5, 6% or 7% for 5 to 7 years, that's possible if you take some risk in the portfolio, if the structure, the deal right in a portfolio company. In the infrastructure equity side, we are more looking for generating 6 to 8 in a core plus portfolio, over 25 years. So that's a bit the choice which investors have. Do they want to have a yield for 5, 7, 8 years, or do they looking for a combination of dividends and capital gains in the long run? That's a trade-off, and we do both. Our balance sheet invests both in infrastructure debt, but as well in infrastructure equity.
One of the key features on infrastructure, at least what many people bought of, is that you have some inflation protection. At least what people already told in the past. Now I'm just curious, how does that work? Because we actually do have inflation, so we have the first testing phase. Can you give some insights on which part of the portfolio this works, and maybe on which part of the portfolio this works less good as anticipated? Can you elaborate a little bit on those points?
Right. So the infrastructure equity market is not homogeneous. There are a lot of different sectors, a lot of different business models, a lot of different regulations, and so on and so forth. For example, in the in the energy grid, for example, there are, for example, in Switzerland, there are regulated returns. So the providers, for example, Swissgrid or the smaller EVOs, they can it's a cost-plus model, and they are allowed to charge to the customers cost of capital, and these cost of capital are adjusted on a formula, and part of the formula is as well, nominal and nominal interest rates. So if inflation jumps into, nominal rates increase, and then you can, with a time lag, charge these additional capital costs to the customers. So inflation protection is indirect very often, sometimes direct, but it comes with a time lag. It's not all of a sudden. I mean, now in these days, if you increase energy costs for customers by 40%, I mean, that's a huge jump, and you get a lot of pressure as well from the customers. And as well, if inflation goes down, so cost of capital, if everything else remains equal, then it goes down as well. It's on both directions. So currently we benefited a lot last year, over the last 2 years, from that, and some of these future cash flows that increased are not yet realized. But you are able to charge, and that's what I mean by creating additional resilience in the portfolio. I think there's the benefit of these type of investments. So with a time lag, you can build better portfolios.
But you have a time lag, so that's definitely something which adjusts later. So
yes.
In that time, it doesn't
yes.
work yet. And is there any areas, or maybe also probably areas which you cannot unlimited adjust?
Yes.
Probably as well.
Yeah. Sometimes there are
Is there any areas, you just talk those which are nicely, which we think all there? Are there any areas which you're maybe a little bit surprised, or which you think, okay, it goes much longer till we will need a more stable environment again to catch up what's happening right now?
Yeah. For example, airport. We are investing in Terminal 1 in New York, so one of the largest airports in the world, and there we are building a new terminal together with other investors. And there, of course, now with inflation, with the supply chain topics, I mean, costs increased. Huh? So, of course, we had contracts with construction, company. And as you know, I mean, it's always about trading. If you have a good contract, but it doesn't help you if the constructor cannot deliver on time, and then you have to discuss and find solutions, even if you have contracts. So there are, for example, some elements. So cost of capital, cost of labor increased as well. It's not that dramatic as our project are capex intense. So capital is much bigger than the operational costs compared to if you look at the P&L of a company, and there are some topics which you can't be protected properly at 100%.
But still, you're somehow protected. I mean, that's a good thing. But I just wanted to see the limitation as well.
Maybe one word.
Yeah.
In our portfolio, maybe direct inflation-linked cash flows is about maybe 60 to 65%, and maybe 20 to 25% addition is indirectly protected, and the rest is not directly. You're not in the contract with the clients have an element of inflation protection.
If I can ask Markus a similar question, you said you're on target in return, which probably many infrastructure was 10% whatsoever. Now, at least in the US, we have an inflation between 6-7%. If I add that up, I would have to go not to 8 to 10 anymore. You can say I'm on target, but you're on target on the old target, but not the new target in there. So shall that not be, because of this higher environment of interest, standard interest in there, a higher target as well? And how much, what's your experience on this inflation observation at the moment of the asset class?
Also inflation, to come to that topic, I would say what you just said, 60-70% directly and then like 20% indirectly is already high. I think we are from the infrastructure side invested in a couple of 100 infrastructure funds. I would say more 50% of the assets are really directly inflation protected. But then it's also linked somewhat to the portfolios you take. So in recent years, there came more private equity-like deals, more higher returning deals, which have less yield, but a pure capital gains component. So think about data centers, for example. And there, high returns are higher, but you have less or no yield. And at the same time, you also don't have this inflation protection features. But just there's so much demand and such a growth potential in the industry that you do this type of deals, and you want to have a diversified portfolio at the end. So inflation...
Demand by capital needs on infrastructure projects.
By capital needs, but also for the underlying assets, right? So be it data center, telecommunication lines, and so forth, right? There's a huge need, right? So that helps. And then on the inflation in general, obviously, I would say the net returns, at least in the short term, for investors, inflation adjusted, are probably in many asset classes not what they should be and have been. So there's adjustment period. So everybody obviously hopes inflation is coming down, but I would say the net returns or real returns probably come down to a level where it's not maybe justified to invest in that asset class really long-term, considering the risk. I'm not talking infrastructure, but in general, right? So I would say there's a certain adjustment period, and once that's over, typically it takes somewhere between 6 and 18 months, and then it's kind of in a steady state where it makes sense again for most of the investors.
Okay. Now, you just mentioned, and of course the needs are a little bit different, but at the same time, many of the infrastructure investments are lifespan for 15, 20, 25 years. So I think there's some time to adjust for there. And do you still have then the same clientele to come in? Since, if I understand that correctly, when I'm listening to you, it's much more in capital gain than on the cash flow, which was originally one of the major feature, cash flow protection by inflation somehow, where people went into it. And now you have this long time span in there. Do you see that the kind of demand by investors is changing, or is that something which you're still on the playing field and maybe a little bit different at Swiss Life than at UBS, as Markus was mentioning?
I think the institutional market developed quite heavily over the last couple of years. So, 10, 12 years ago, not a lot of institutional investors in Switzerland invested in the asset class. But thereafter, people started, and of course, as in the listed market, you can invest in many different ways. You can have a value style portfolio. You can have a growth portfolio. You can combine different regions, different sectors, or just focus on one or two. And that's as well possible in the infrastructure space. So it's such a big universe with multiple different ways how to invest, whether you invest directly in companies, or whether you invest in several different funds, or whether you invest in several fund of funds. It's a completely different style. And some of our investors like we, from the balance sheet, we usually invest, we tend to prefer investments in our core strategy with high dividend yields. So if we want to achieve 6 to 8% net returns in Swiss francs or euros, we would love to see 70–80% of that return coming from dividends, and only a small part from capital gains. Other investors, we also have, a more value-add strategy, so a bit more risky, but also higher expected returns, up higher than 10%. There you have to take over additional risks, and there also usually the holding periods are a little bit smaller, maybe 8 to 10 years, and with no or very low dividend and higher capital gain orientation. And if you look at that, it is a completely different universe. So if you compare one fund with the other, you have to look into the details in order to make a good choice. and to understand what you have in the portfolio. And that, let's say, thinking and that understanding that grew up over the last couple of years substantially.
Okay. Yeah. Then, because I think it's a cool crossover to start with private equity, so then Naji also can start coming into the panel. But Markus, please.
Let me add to that, not making actual marketing because that fund is closed, but just to show how the market is evolving. So we actually, on our platform, just launched a direct energy storage infrastructure fund, right, which is really batteries, because for this energy transformation, you have a lot of needs coming back to the infrastructure topics. Same is obviously wind parks, solar cells, and so on, so coming back to that need. And where in the past you often had like general infrastructure funds investing across many different things, from harbors to ports to energy, now you find actually more and more dedicated strategies where you can pick and choose, and also your risk profile. Another one which we just, for example, launched as a very US topic is food storage. So basically investing in this very old cold warehouse storage facilities, which are 50, 80 years old, and they lose so much energy, and actually a lot of food waste is generated there, that you basically now start to change in the US the fabric of the food supply industry. So you have less transport waste, larger storage houses, and then the most efficient storage cold houses you can imagine. That are all infrastructure topics.
Okay, I want to move on to private equity, but I think to sum up before we go over infrastructure, I think what I hear, it's a very old asset class, over 100 years, just very popular the last 10 years, and it's evolving still quickly, and you see a lot of demand on capital, so therefore there will be a lot of solutions coming up in the future as well, with more precise, different positioning where you're able to invest in. Would that be a fair statement from you two?
Yes, absolutely. And I think one additional point, I think people understand that it makes sense to invest as a country in infrastructure. So our generation benefited a lot from our parents and the grandparents of us who built all the infrastructure. And sometimes we just consume it. It's cheap. It's always there. It always has been there. And we do something else. But we see it now in the energy crisis. We have to make sure, as a nation or a country, whatever, that we are prepared for the next cycle. And if we don't do that, our children have to do that, or they lose growth potential in the long run.
Okay, I would like to move on to Naji. What has changed in the private equity markets at the moment, given the whole environment than a year ago, where the interest is now back and inflation is back? Can you elaborate on that, please?
Sure, and a lot has changed actually, because cost of financing is not cheap anymore. So, and banks are tightening. All the crisis we're seeing in the banking sector is driving more and more tightening. I'm not sure who can fix this, but so what is happening? If you're looking at private equity transactions, there are happening. It's a bit, less transactions happening. Definitely, there are. Private debt is replacing the banks. If you look at this year, for example, or last year, you had around 200 billion of private debt that was supporting private equity transactions. That's the equivalent of the syndicated loan market. So private debt is playing a role, which has been a growing asset class for the past 10 years. The second thing is you're seeing smaller deals happening. So you have deals in the size of 100 to 500 million. Today, it's not
which needs less debt.
Which is less debt, of course, and less reliance on banks to lend. And the third one is private equity sponsors are putting more equity as well. So a typical private equity might be 50% equity, and you get the financing of 50%. You're seeing much larger equity stakes. We just closing on a co-invest, and this is an SAP company. Went IPO 2 years back. And it got just taken private again by Silver Lake and CPPIB, the Canadian Pension Plan. If you look at this business, it's around 12.5 billion of enterprise value, and we're only putting 1 billion of debt. So you're looking at a private equity
almost no leverage in there.
That has been mainly equity. And I think the environment became much more institutional, which you can do those things, especially with all these factors. So that's what we are seeing. But clearly, it's not the same pace of activity that we have seen this year compared to last year.
So what you don't see anymore at the moment? What's the opposite?
Leverage buyout, for sure. We have, one of the transactions that was very much in the press was Cotiviti, which is a big healthcare deal. Carlyle was going to buy this business from Veritas, and the pref equity and the second lien debt was much more attractive than the equity returns, going back to where is the relative value today? Do you put your money in debt, or do you put your money in equity? And when you look at this transaction, pref equity was much more attractive, and therefore they couldn't get equity for this large LBO business, and the deal is not happening. So this is what is not happening today, is much more the LBO side.
Okay. Markus, how do you see that on your private equity markets? I mean, we have the real bonds, which have actually yield, so therefore the bar went up, which you can very cheaply invest, and private equity traditionally is a little bit more expensive, but also give a much higher return. So what have changed on your side, and where are the sweet spots which you are engaged at the moment?
So the first question is even more pronounced on the capital, availability of capital side. So fundraising, particularly for large investors, even if they are performing super good, have performed super well, has become extremely difficult. And the main reason is twofold. One is competition with fixed income, where now large allocators of money say, well, why put it in a maybe risky asset class where maybe at least on the short term the outlook is not 100% clear. We still have a lot of uncertainties given inflation, given war and so on. And then the other one is the denominator effect. So a lot of the large allocators who invested before hundreds of millions in a fund or in a deal have now only tens of millions. And actually some of my colleagues have been last week on AGM session, so investors meeting for private equity firms. Very good firms, mid-market, large funds, mega funds, and they're all seeing the same story. Basically, it's brutal to raise money. So that is on one topic. And then the second one, where we see the opportunities. We mostly have, basically for the last 22 years we're doing this. We have done mostly only primary investments. Last couple of years we've changed. We do now a lot of secondaries and co-investments. And actually this year may be the first year where we do more secondaries and co-investments, which we call transactions, than primary investments. So the reason is that at the moment you have basically, for the last 10 years, the first time real purchase opportunity or buyer's market. So you have typically declined valuations, you have weak or not stellar operating company performance, so this drives already enterprise values down. And then if you are in the secondary market, on top you have a quite decent discount not seen for the last couple of years. And secondaries in brackets is buying into fund positions which are running already since a couple of years. So usually private equity funds run for 1 to 10 years, also 10 to 12 years I should say, and then secondaries buy in after the initial fundraising period has been finished. So, and we see the market opportunity, and actually what happens is primary funds still sometimes don't believe what's the fundraising environment. They play these games they've played the last couple of years, like you have to commit by year end, otherwise the fund is full, and we say, well, good, go ahead. We like the secondary deals or co-investment deals at the moment more, and then we passed on that fund manager, and now they came back there in January. Oh, we thought we extend the fundraising for another 6 months. So completely changed dynamic. That then translates into you have more time to work on the due diligences, you have more better negotiation position on the fund terms, on the management fees and so on. So that all scatters very much through the entire landscape, the current environment which we see.
Naji, do you see the same direction, this new opportunity? It seems to be an oversupply, an opportunity where people really want to go out of the class, because I mean that's one point where secondary exists. Is that a similar observation on your side?
Yeah, and definitely, and maybe things to add. On the secondary side, on our side, we do more the GP continuation theme than the LP secondary. So you have the two themes in secondary, which you mentioned, buying LP stakes. So somebody invested in a fund and they want to get out, you can buy it at a discount. And there is another strategy, which is GP continuation, where it's much more impacted by the lack or the difficulty in exiting today. You have a very weak IPO market, and that has been impacting a lot of the exits. So GPs and sponsors who own a business, they like this business, they want to continue investing in this business, they are doing a continuation fund to allow existing limited partners to get out, and then bringing new limited partners in. And this theme is quite interesting today because you have a solution for existing investors, and people like us are coming in not only at a discount, but we have a very clear visibility as what we are buying for the business. And our view is that the IPO market will not be shut down for the next 5 years. So you can be exiting in 3 to 4 years and driving a return in the GP continuation theme of around private equity return. So we add this to...
So logically, say the IPO market is not over the next 2 or 3 years. So we would assume that in 3 years from now, we would have a little bit less interest rate environment or inflation more under control. Or is that much more hope on the future?
No, I think just the market conditions are going to get better. Hopefully, we will not get into a full-blown banking crisis, and then the market could just normalize, and then we have a healthier IPO market. But at the same time, I think if you look at exits, you have 3 types of exits. You have the exit through IPO, you have the exit through corporates, and you have exits from sponsor to sponsor. And today, none of them are really working. IPO is not happening. Corporates, they want to keep cash on their balance sheet for defensive positions. And sponsor to sponsors, they're not agreeing on what's the right price for the asset. And therefore, you have the GP continuation theme that comes as an interesting play in today's environment. That's one thing I would add to what Markus just said.
Thank you so much. Time is moving quickly. I would like to give the opportunity to questions, since we have so much know-how on both sides, private markets and infrastructure in specific. Who would like to start?
Private equity.
We have a microphone. Please, Andre.
So question to all 3 of you. So private equity can make sense for institutional investors as they can deal with capital calls, etc. How about the access for private investors in a mandate, for instance? Would there be a possibility solution with private equity secondaries? They can more tailor-made, we don't have any capital calls. How do you see this? And do you have any precise or solutions in your portfolio to offer to potential clients? Thank you.
So should I start? So secondaries obviously has historically been always a way to build up portfolios. Plus, people like it because usually you know what you're buying into, so you don't have a blind pool. And then in addition, you can actually due diligence something, right, which gives you a lot of comfort. And then in addition, you're fully diversified from day one. So secondaries have a lot of benefits, especially for building up portfolios. And then solutions, well, as you heard, so for us, usually in every private equity product or mandate, secondaries have a portion in that, and then given on the market environment, sometimes more, sometimes less. And actually, last year we launched, which is actually innovation because it doesn't exist, a semi-liquide fund, which is only investing into secondaries, because that's a tool basically for investors to come in, be fully committed, and then on a quarterly basis basically decide, do you want to get in, do you want to get out, so they can more actively manage their private equity allocation. There's other semi-liquid funds out there, but on the secondary market, which we think is actually a perfect match, because you can somewhat control better the liquidity by the way you buy into secondaries, so the whole period.
Christoph, do you see some trends as well, trying to bring infrastructure into the more private wealthy area, as the questions relates to? Or is that too early?
No, it is a topic. It is a topic we received over the last couple of quarters, several requests from investors. And I think it is about, it is an illiquid asset class at the end of the infrastructure. So we don't want to sell something to someone who doesn't understand and want to get out and make money very quickly. that's not the right asset class to be in. So we want to make sure that investors are long-term investors in the fund. But I think what people realize that there must be somehow some windows of liquidity where private investors can realize or adjust their allocations, or for whatever reasons they need cash, that they can get out at a reasonable, within a reasonable time frame. But that needs a little bit of time, and that needs the understanding that it is not something, an ETF, and I think that needs education. And but I'm very sure, and I mean, that there are several providers in the market looking around. Some people talk about democratization of private markets and stuff like that. I think it's about giving access to this asset class, providing something unique, what they can't access in another way. But I strongly believe that it must be structured in a way where it's good for the other investors that stay in the fund and provide some liquidity, but not a daily, not quarterly. It needs a bit more time.
It's always the conundrum, illiquid asset class to try to be some liquidity.
That's true. It's not possible. Yeah.
Maybe two comments on this point. If you look on our website, it's private markets made accessible. What we have done is we worked very hard on trying to identify a solution for private investors. And you see today a lot of the solutions that are coming up are feeder funds. That's the solution. On our side, we're building co-investment portfolio and secondary. So it helps you getting much more visibility as an investor. And we put it also, added to it a secondary marketplace. So if you are an investor, and we're not offering semi-liquid today. We're not offering, because people have the perception they can be liquid, but everybody wants to get out when they want to get out, so it becomes illiquid. So what we have done instead is creating a secondary marketplace. So when you look at your portfolio, you want to get out, you just put it through our application. We have an app on this. And then you say, I want to sell it. And then anonymously, people see that there is a position, and you might want to sell one position or the whole portfolio. And I think that allows this type of liquidity offer being offered to investors. So that's how we address that.
Thank you. Any further questions?
Yes, thank you. One of yours has said that the exits are closed, right? To IPO or any other possibilities of selling to corporates. How about the real value of private equity? I mean, if someone has really to sell, then you experience normally what the real price of whatever is. What kind of hidden premiums are in the valuations nowadays?
I'm happy to start on this, and it's a good question. I think today you're still seeing a very big bid and ask spread between buyers and sellers. You have sellers who are thinking of last year's valuation, and you have buyers who are thinking of next year's valuation. So that is what is happening today. You have a bid and ask spread. I think the transactions we've done, and we've done few of them this year, we've closed on 4 co-invest. And the last example I gave you, which is the SAP, so it's a B2B software, and compared to IPO price, which was IPO 2 years ago, we're buying it at 40% discount from IPO. And it's a take private transaction, and this is more and more happening. So I think it's coming, but it's not, definitely today you're not going to see a homogeneous pricing. It is still a bit wide bid and ask spread.
On the liquidity, maybe, yes, IPO windows are mostly shut, but if you have a global view of a portfolio, so we mostly make global portfolios, liquidity is not that bad. So we are still, everybody has to understand the last 2 or 3 years have been exceptional. So, and then really the question is how related. So usually referred to like distributions versus the net asset value base of the year prior. And then we are still in a between 25 and 50% on the third quarter in terms of distribution. And that's based on our data, but the environment is not so bad. There's a lot of deals, especially on the M&A side and the financial sponsor side, still happening. But it's more small, it's more mid-market. IPO, which usually then ends on top really extra returns, that is pretty much closed. But still, the backbone for private equity returns distributions has always been the M&A market, be it to financial sponsors or corporates, and that's still happening. And so for that reason, again, the last couple of years were just exception, and now we are back to normal or a bit subnormal territory, but it's still okay, I would say, from that perspective. And there you see actually a lot of transaction happening. What is the real value, right? Because many buyers are not forced to buy it. They want to have the asset for that price, right? And again, I have to say, we focus more on the smaller mid-market, right? Because we think it's, for a private equity investor, there's more value to be generated in companies than when you're on the large and mega end. Because often these companies, I was once a consultant myself, these companies have been worked on the large S&P 500 companies. They've been worked on so much already that in order to achieve private equity returns, you need either leverage, you need a very cheap buying opportunity, or you need a hell of a lot of corporate projects, 50, 60, 100, to really turn every screw to deliver the private equity returns. And in the small mid-end of the market, usually have the CEO, founder, the CFO, 2, 3 very senior managers, and they drive the company. And they have zero time and money to really follow M&A strategy, a new market entry strategy or whatever. And this is what in private equity is helping with skills and with money. And so for that reason, we prefer usually a smaller and mid-end of the private equity market.
To give you a practical example, last year we sold a portfolio of 12 companies in one transaction. 4 of them were then, the deal at a value of with a discount of 3%, 1 to 3% of the price that we had in the books, and 8 were between 5 to 20% above what we had in the books. So I think in general, it's not so easy to answer your question. It very much depends on what fund. But generally speaking, I mean, if you look at the valuations and the valuation guidelines that, the large funds have to implement, and the valuation agents, the external independent valuation agents doing the valuations, they look what's happening on the listed market. So the time is gone that you just can keep it in the books at 100 and wait for 10 years and then you sell it for 400. You have to adjust and market to market value in a market to market valuation. That's clear. I think it's over, this huge discount thing. But of course, you need to know what's in the fund, what's the proper value of the portfolio assets, and at which price you get the fund.
Okay, it's a great opportunity to get the same question answered by 3 specialists. Time is moving up. I think I have one final question we can take if there's some around. Otherwise, I will close. Okay, then I would sum up. Thank you very much for being here. I think infrastructure, where we here, is an asset class which is very long-term in existence, but I think a lot of demand out there, and we will see a lot of development in the next future as well, in further professionalization and probably also opening up to other investors. And in private equity, I understand at the moment is a more difficult market, especially the appetite of investors is not so huge. That's usually not the worst time to do something, isn't it, in hindsight? With that remark, I thank you very much and wish you a nice afternoon. Thank you.